Welcome back to day 34 of streaming. We're back. We didn't stream earlier today. We didn't take any trades earlier today. And that is because I am going through a change or introduction of new components to the strategy. So I don't want to get practice implementing them just yet because we are only on episode 2 or 3 now, actually. The first thing I would like to say is they feel I wouldn't make it. 2 hours left. They're probably counting down. There's probably somebody out there watching. Thinking, oh, he hasn't gone live today. But we're gonna do our best to ensure that we turn up for every single day of the 1,000 days. No excuses. So, just to recap what we did last time. We went over episode 2, we rewrote some of our notes and we made them a lot clearer, turned them into more actionable steps so that we can actually implement the strategy when we're actually looking at the markets. So weekly, we've determined its useful direction. We're determining whether the weekly candle is going to be bullish or bearish for the next week. We then have our reasonings being the underlying tone of the market, where market is drawn to, which would be balances and or lows slash highs, basically liquidity. The daily is where we find that liquidity. We look for the swing highs and lows, and we also look for the balances on the daily. These are magnets to price, and it's done a daily time frame, which high institutions or big financial industries or entities rather are looking for liquidity. They look on predominantly the daily time frame. The drawn liquidity is what DOL stands for, is what makes the market go higher or lower, and is mostly done in this time frame. After the weekly bias, we then scale down to the daily, where we see how we are in relation to the weekly, right? So, for example, we have, I believe this might be the daily, but let's say we have the weekly candle and we're predicting it to be bearish. We then go to the daily time frame. Your most recent candle may not be bearish, but you may even go up before you go down. So you could be bullish on the daily, but bearish on the weekly. That's possible. But the point is that we're trying to see where we are because we predicted the weekly bias. Let's say we've predicted bearish. We want to see, okay, what's the daily doing in relation to the bearishness? Are we retracing? Are we retracting? Are we rejecting? What are we doing in relation to the direction bias we got from the weekly? And here we highlight how price draws to one of the two things, being stops and imbalances. So then we scale down to an hourly time frame, which is where we find buy side and sell side liquidity. Now, obviously, we have external liquidity being on the daily time frame. Internal liquidity can be very present in the form of the hourly time frame, where we target short-term highs and short-term lows, being the buy stops and sell stops. What that means and what that's used for is to engineer liquidity. Price needs to get to external liquidity. How does it get there? It utilizes internal liquidity to get there. I always say that internal liquidity is the footprints or footsteps before or in the path of reaching external liquidity. So to reach external liquidity, you got to use internal liquidity, right? So hourly is where the engineering of liquidity is done. When price is consolidating on the hourly time frame, we look for this move where we sweep in one direction, sweep in the other direction, and then make the move downwards. It sweeps and takes both highs and lows. Why does it do that? Well, you got to think. Liquidity is not direction. Liquidity is just fuel, right? If you're consolidating for a large amount of time, there's going to be a large amount of orders above and a large amount of orders below. And because of that, institutions want that to fuel bigger moves. Bigger moves equal more money. So when you have that consolidation and then you eventually get that sweep of one side and then the sweep of the other, you have taken out sell side liquidity and buy side liquidity. That is a lot of fuel to then make your orders, or rather to then make the actual push. That's the best, simplest way I can explain it. So when price is consolidating on the hourly time frame, that's when we look for such opportunities. I called it the double sweep, right? I'm not sure what Michael calls it, or if there's actual terminology for it, but for now, I just call it the double sweep. On the 15-minute time frame, it's pretty much just zooming in for the idea of what we had on the hourly. We can see the liquidity that we've marked out with the trend line on the hourly, and we utilize that tool to showcase buy side and sell side liquidity, and we can zoom into to make it look clearer. Then we finally scale down to the 1, 2, and 3 minute. I currently have the 2 minute unavailable as I'm not paying currently for the, I believe it's the Trading View Pro plan or whatever the plan is that's above free. You get access, I believe, to more time frames. I do not pay for that as of now. Used to, not right now. So I can use the 1 minute and the 3 minute. I've been using in the past 5 minutes minimum, but ICT said that we could use 1 minute and the 3 because that's what the algorithm is sometimes searching for some imbalances. So once we've had all these prerequisites, which we've got from the higher time frames, we can then scale down to these 3 time frames to then look for opportunities, which will be the fair value gap, which is an imbalance to create it, and then a retracement back into that imbalance to then continue and deliver to our take profit or direction that we predicted from the start. Then we included things to implement, which is the things that we're going to implement into our strategy. So essentially things that we can actually just read this and execute at the end of it. That's my goal. I don't know how long this will be, but it will be something that we carry on throughout all the episodes. The point behind the upper bit is to study for us to gain understanding and to create some structure, which we can then use that structure to then draw a strategy from. Okay, so that is everything summarized from what we learned from last week's session, which was 49 minutes long. This episode is 52 minutes, but I'm tired. I'll be honest. So I don't know if I will be able to watch the whole thing, and I'll also be watching on a faster speed anyway, so we may even end up not being here for that long. But we'll see. We're going to go with the flow. I'm going to do my best, and then I'll pick it up from tomorrow, which is a Saturday, but kind of my days have been low-key skewed, but it's all good. And so here we go. Let's begin.
All right, folks, welcome back. All right, so this is the Tuesday, January 25th, 2022 ICT Mentorship on the YouTube channel. All right, so this is the internal range, liquidity, and market structure shifts lecture. All right, so I gave you homework on the community tab. If you have not been paying attention to that, that's where I'm kind of keeping you abreast as to what you should be expecting next or something that just comes to mind that I feel like sharing. So this is the link I sent out the other day, and I wanted you to go through this particular chart and look for reasons that provided the market structure shift and the buy side and sell side liquidity. So if you have not done that, please stop the video and do that now. Otherwise, you're through this particular chart out the other day, and I wanted you to go through this particular chart and look for reasons that provided the market structure shift and the buy side and sell side liquidity.
Okay, so I didn't do this, so let's do it now. So essentially he's saying, well, from what I can gather, he wants us to have or to find reason for market structure shift and buy side, sell side liquidity. I'm not too sure what that means, but what we can do is just mark those things. Right, so over here we're bearish, creating these low lows, low highs. Eventually we then take out this high over here with this 2 candlesticks over here. And then we sorry, I think I've got bits or something because so it cheats. Info on my sides. It's fine. So we have a market structure shift over here. We then have a market structure shift over here where we take out the downside. Then we continue down. Then we have a market structure shift over here. And then, of course, a market structure shift all down here. So I'm going to explain all of them, or at least to the best of my ability. I'm not exactly sure I understand the homework, but I'm going to try to do my best. He might give us more information, but I'm just going to do that for now. So bearishness, we can see that the bearishness got taken out over here with these 2 candlesticks. This isn't a fair value gap because there's overlap, and it started from here. So there was a engulfing, sideways move, engulfing. So you could say that boom to boom isn't a fair value gap. Boom to boom is imbalance. So 1 imbalance, 2 imbalances, and that caused potentially price to move that way. Because if you now look here where we create a lower low or change in state delivery over here to a slight short-term bearishness, we have from this candlestick to this candlestick an imbalance as well. And then what do you see follows? A continuation of that. Then over here, when we have this push to the upside, we have another imbalance over here. And what do? We take out the high, and unfortunately, we don't continue, or at least for the sake of this example. But what we do then do is have an imbalance between this candle and this candlestick, and then we head towards the downside. So there's an imbalance in every single change in market structure. In terms of buy side and sell side liquidity, here we go. We see equal highs over here. See a sweep of it and a deliverance to this low down here. Then we see a sweep of that. So as you can see by this wick, we take out that and then we push up. Then we take out these highs over here. Once again, what do? We head to the downside. So the imbalances and the sell side and the liquidity, sell side liquidity, or slash buy side liquidity, we see that is present in every state of change for price. But let's see what he meant. If he gives us that reasoning to what the homework was meant to be, and then if not, then we just see the answer.
If you have not done that, please stop the video and do that now. Otherwise, you're cheating yourself of learning opportunity. All right, so here is that chart. Again, 15-minute time frame on the E-mini NASDAQ 100 futures contract for March delivery 2022. And take your attention over here, okay? This old low and these relative equal highs. See that? Old low, below that is sell stops. And relative equal highs, above that is buy stops. Now, you could have used this high here. There's nothing inherently wrong about that. But whenever I see equal highs like this, and if it's higher than an old high over here, I'm going to use that. So that way there's a little bit of insight for your study journal. The sell side liquidity, you can see that the market trades down, hits that, runs through it, then rallies all the way back up, clearing the equal highs. So the buy stops have been taken here, okay? So at both of these price points here and here, that's the, I guess, the point at which you'll look for or anticipate a market structure shift. And you don't force it, okay? I see a lot of people try to teach my concepts. It'll talk about market structure breaks or shifts, and we'll use that term interchangeably. But for intraday, I want you to think about intraday market structure shifts, because it's not necessarily a break in market structure that leads to prolonged multi-day movement, okay? What do I mean by that? If you see a market structure that's bearish and it's broken to the downside, intraday, that may just lead to an intraday price leg that may eventually see that high be taken out in the same day. So that's why I'm using the term market structure shift, not market structure break. For our conversation here on this mentorship, just know that when I'm going to lean on that term market structure break, it means a little bit more in context versus an intraday shift in market structure. It just means that there's likely a downside draw or an upside draw intraday by saying the term shift. Okay, so there's a little bit of semantics there. All right, so we have both of these areas here and here where there would be a likelihood of a market structure shift. Up here, we look for a fake run above here. So that fake run above, how do we know it's going to be a market structure shift that's bearish? I get that question a lot, even from mentorship students. What you're looking for is the evidence I'm going to show you here tonight, okay? Forget everything else everybody else says about market structure breaks and shifts and all that stuff. This is it, okay? This is the brass tacks. There's absolutely nothing else that you need to know about it. I promise you. If they add anything to it, it's just because they want to sound and look different. But this is the algorithmic perspective of a market structure shift intraday. Now, keep this price level in mind. So it's essentially 14,600 and 14,820. We're just eyeballing it, okay? Now, dropping all the way down into a 2-minute chart. This is that same particular day. Here's those relative equal highs. And this run down here, okay? If you recall, 14.6 and around that 14,860 or so, okay? If you look at this market structure, without having the levels on your chart, it's easy to get lost in all the quote-unquote noise, the uninitiated. And I know it's going to razz the people that don't care to really learn here. But the uninitiated folks that will watch a video or listen to some of the lectures I'll put out, they're trying to bring something in. They're trying to bring in their preconceived notions and ideas about what they think they understand about markets or technical analysis or something in price action. And I want to kind of like allow you to just put that aside for a moment and just imagine this chart is the first time you looked at price action for the first time. I know it's hard, but kind of like strip away everything else that you want to bring to the conversation. No order block discussion, no breaker, none of that stuff, okay? Supply and demand, Elliott wave, all that garbage. If you look at this price action here, when we had this low form, right before this low was formed, there's a swing high right there. Now, in the first mentorship video I gave you, I mentioned that high frequency trading algorithms will use market structure on a 3-minute, 2-minute, and 1-minute chart, many times sub 1 minute. That would be like 45-second, 30-second, 15-second intervals, okay? What the algorithms are actually doing, and this is also going to correct a lot of people out there because they put out misinformation. It's so nonsensical, but I'm challenging you to go into your charts and see if this is not what's actually going on, because it happens every day. If high frequency algorithms are operating every single day, then these signatures will be in the chart, okay? If you look at this short-term high here, right before this low formed, when this high is taken out right there on that candle, that's significant. Only if this run down here has traded into sell stops, okay, below an old low of some kind. It could be a double bottom, it could be a single low, okay, but it's got to be trading under some retail idea that would be viewed as support. Up here, the same thing. We're trading above highs, so we know that above old highs, a neophyte's perspective will be, these are unknown orders, so therefore that's a flawed perspective on price action. How do you know there's liquidity up there? How do you know there's buy stops up there? It's just logic. It's simple. Look at the chart. Everybody's trying to do something based on some kind of theory, logic, whatever, some system. There's buyers and sellers coming in at all times. Their buying and selling, quote unquote, strength or pressure has absolutely no bearing on where these prices are going to go. I know that may shake individuals that think they know something about the markets. Oh, I have an uncle that used to be on the floor of the Chicago Board of Trade and blah, blah, blah. The Mercantile Exchange guys say this. I don't care, okay? I don't care what any of those folks say because they didn't design the algorithm. So, again, put all those talking points and everybody else's opinion you've adopted because you probably heard someone else talk about it and you subscribe to the review because it's easier just to do that instead of going and looking at it for yourself. And that's what I'm asking you to do. I'm telling you, this is my personal belief. You're going to see proof of these things in a live account execution. But I want you to see the logic behind it, because if you can see this, you'll be light years ahead of everyone else. And you'll laugh in the face of all these people that are going to tell you you're wasting your time trying to learn this. I promise you, this lesson is going to change a lot for you. When this run above these relative equal highs happens right there, you're anticipating a market structure shift. You're not forcing it. You're not trying to get ahead of it, okay? I don't think any of you are going to have the skill set to do that. There are ways to know when to sell short right above that and not even wait for the shift in market structure. Just like there's ways to know to be a buyer down here without seeing that short-term high broken, then looking for a buy. Over here, the opposite. See this swing low? Let me go back to this for a second. We have this high on this candle, then we have the candle right after that here, the highest one, and then the lower high of this candle here. So that's a swing high. Very simple little pattern, but it means a lot when it's in the proper context. When this high is broken with this particular candle right there, that is significant only on the basis that we have taken liquidity out of the marketplace. That's it. So when it broke this short-term high, this is more meaningful. And then the market will start to seek buy stops, okay, or buy-side liquidity. That would rest above here, here, and here. Now, I shared an example of live executions, and I was teaching on the idea of utilizing micros, which are essentially $2 per handle, okay, so or 50 cents per tick. This chart is NASDAQ E-mini. This would represent $20 per handle. And there's 4 ticks in each handle. There's your $20 per handle. Okay, so again, what that means is 14,680 to 14,681. That's one handle or 4 ticks. There are some that will doubt the idea that you can trade all these little internal swings. Okay, and I'm going to give you some insights on how I was doing it. Okay, the main context of this lesson is for you to go in to your charts and try to prove me wrong, okay? That's the challenge here. That's your homework. I want you to learn what I'm doing in this lesson here, and then you go into your charts, back testing, and I'll show you what that looks like. What does it mean to be back testing, and what you're looking for, and how you're going to screen capture, all those things. But your mission is to go into the charts and look for this not being true, okay? This is exactly what I did on baby pips back in 2010. I told everybody, do not take my word for it. Don't take my word for it. Go into the charts and see if this is true or not. I believe it, but I don't want to try to convince you, because I won't. You'll convince yourself. Once you start seeing it, it's over. There's no argument after that, okay? But it's simple logic. Very simple. This is a very clean chart, is it not? All I'm going to do is add a few annotations, and this is about as extensive of lipstick we put on our chart. I know it's shocking, right? Can you still see the candles? Because it might be a little obstructive. I'm being facetious. You see these guys out there with these charts that have graffiti all over it. You can't even see the price candle. Nothing. You can't even see any of it. But there's all kinds of overlays of all kinds of nonsense, which means absolutely nothing because algorithms could care less about any of that stuff. Triangles, harmonic this, crabs. It's crazy. I know. But hey, everybody's got to have a religion. So here's those sell stops. So this little area here it's shaded in, that's a area where sell stops would be residing below that 14,600 level, okay, on that 15-minute time frame. So the market dove into that liquidity, and you may or may not know that is a buy. You don't need to. You anticipate a shift in market structure. When the market rallies above, when does that happen? On this candle right here. See that little light bulb? That's when you're thinking, okay, now I have a condition in the marketplace that I might see an opportunity intraday. Let's see if there's further evidence to that. Short-term high is taken here. We traded above it. It does not need to close above that. Okay, real important. Once that candle closes and this candle opens, you're going to monitor this candle. And you want to see as soon as this candle closes, does it create that fair value gap? If it creates a fair value gap, again, that's a candle at the high, one single pass up. Next candle has a low that doesn't completely overlap all this. That's a fair value gap, real simple, okay? This candle is where you would look to potentially trade at the earliest because now there's a gap there. The market trades down into that, boom, takes off. Here is insight that everybody needs to understand because they're out here running around on YouTube trying to teach order block theory. Order blocks, okay? I invented it. It's mine. No one talked about it before me, and I first mentioned it in 2010 on baby pips. Prior to that, 1996, I was only teaching it to people one-on-one in teachings. That's it, okay? You can't find it in books prior to that. It's mine. No one else taught it before me. It is mine. So I'm going to correct all of you today so that way you can teach your people correctly and not hurt them. See these down closed candles? See that? That's all one continuous order block. What's it doing? It's inside that pool of liquidity, sell stops. Where's the open on that? A series of down closed candles right here. That's the price level extended out in time. Boom. So inside this fair value gap, this opening price on the order block, that's your buy, plus 3 pips or whatever for spread. And that's what you would use for a limit order. That's pretty neat, isn't it? Well, price starts to run where? Above the highs where buy stops would be here, above this high here, and above this high here. Now go back and look at the example where this particular day here, I put in orders and I was still learning how to use the Thinkorswim platform. And there's a little toggle box where if you toggle it, it'll send your order right to the marketplace. It won't let you review it. And I had put that on to see if it was going to show me any kind of information on the screen, but it didn't take it off. So what happened was I put that on, and it was actually an order that I mistakenly had in. So I was hoping to see if it could give me an opportunity to get out of it and cover with next to nothing, or maybe even squeak out a profit. It wasn't having it. So I had to reverse and then go back and go short, wrote it down, and then you'll see me covering in here, and then going long, selling short, reversing, going short, buying long in here, inside the order block, rallied up, sold the long, reversed it, bought it here, got out over here, and resold for that big run into that, okay? That's what I was doing. There's people out there going to tell you, he doesn't trade that way. These people don't know how I'm trading. You have no idea how I'm trading. None of you do, okay? I'm teaching you, obviously for those individuals that are outside my paid mentorship, which is not open, so please stop emailing and asking. People are still sending me emails, can I join? No, you can't join. Be content with this. I'm teaching you gold, and it's costing you nothing but the time to sit down here. And if it doesn't work, you're going to know right away, okay? I'm not wasting your time. I'm going right into the brass tacks. That way, the people that are weak-minded will know right away this is it or it's not. That way, you'll know this is too much work for you. And that's fine. Go and do whatever you got to do, and I wish you good luck. But the individuals that really put the time in and test what I'm challenging you to look for, you're going to see it's there, and it repeats like clockwork, okay? It's real important you have that mindset. So the buy stops above here that was taken, this swing low forms once this candle closes. So this candle we're watching, does it go below that short-term low? It does. So now we have a shift in market structure that is now bearish, only because we've taken buy stops, okay? Fair value gap forms, the market rallies up into that, you go short there. What are you looking for? Below here, sell stops. Below here, sell stops. Below here, sell stops, and in this fair value gap here. So if you are in a position that has multiple contracts, or say you have a Forex trade, because this works in Forex too. It's not just limited to futures. Again, I'm just using this asset class because I cut my teeth on these markets. When everybody else was still in elementary school that's trying to teach today, I was trading the S&P. I probably sound like a young guy, but I'm actually getting ready to turn 50. So I've been around for a long time, 30 years, this November 5th, 30 years, that's 3 decades. And the things I'm teaching you, I'm not teaching you one trick pony insight. These things work on all asset classes. Now, I'm not going to co-sign the crypto markets because that only my students are reporting that this stuff works there. I don't even mess around with it that much to know, okay? But you can take partials below here. I probably wouldn't do it there, but below here, here, and then some of you saying, well, why wouldn't you take them below their ICT? Well, if you're trying to get short here, that's not really that much movement. So if you're going to take something off your trade below that low, why not just try to reach for that one? And you could get it there, right here, okay? And then below that low is nice as well. Below this low, and this is what I mentioned on the first lesson, okay? Elements to a trade setup. This is below the 50 level of this high and that low, okay? So 50% level, that's what we're targeting. Now, this candle's low was the high end or first objective inside this gap. So that's your target. You're gonna look for that. So you're looking for low-hanging fruit, the easiest target to get to. You're not trying to be perfect, and you grow into eventually holding to see if it will fill in that gap. Okay, this fair value gap. And I was going down to this candle's high. That's something that you strive for over time. If you understand what I just showed you here, that's a very simple process of looking for, number one, liquidity, gauging what happens without having to know for certain, because you don't know. You're not going to know until the market shows its hand. This is it showing its hand. Okay, that's it. Now, let's go into a 1 minute chart and see how that looks a little bit different, but still has the same characteristics. Here's that same price structure, just on a 1 minute chart. The same logic still there, right? Swing high taken after liquidity's been traded into. This short-term high gets violated. Right when this trades down in here, what's actually occurring? Okay, put this in your notes. High frequency algorithms are hammering. They're just throwing orders in, buy. That is not, okay, here's an important thing. That is not causing, okay? It's not causing the market to go higher. It's just volume that's coming in. The algorithms that deliver price, that offer price, they're constantly offering the price in the marketplace, that's what's beginning to spool and go higher, okay? And regardless of where you want to trade at, your limit orders, they may not get filled. Where you're trying to buy with a market order, you may think you're getting in at 14,662, but by the time your order is executed and confirmed, you're in 14,664. That's slippage, okay? That's negative slippage. If you were trying to buy it at 14,662 and it fills you at 14,661, that's positive slippage. That's better than what you were expecting. So when price starts to rally, all this is a default to the algorithm constantly offering price at a higher price. Okay, and the logic and argument for anyone that wants to say, oh, it's buying selling pressure, this guy has no idea what he's talking about. I know somebody that used to trade on the floor and he's laughing at ICT right now. Okay, go into your charts. Forget that. I'll let you have that perspective for a moment for the argument. But go into the charts and see if what I'm not suggesting to you is the truth. Okay, I could sit here and do a complete series on all the things that lead to what I'm saying is true, but none of you will still believe it. I'm showing a live account and entries and executions, and they're still doubting it. So no matter what I do, there's going to be people out there, but you didn't do it wearing orange. You didn't do it in your Corvette that you flip, which I don't flip Corvettes. You're getting all kinds of stuff out there, nonsense. But you don't see anybody going into that Robbins Cup. Hello. So we're looking at the swing lower here. Market breaks down, trades back up into this fair value gap here, and sells off. And there's another fair value gap right there. Trades up into that as well. This is a 1 minute chart. So it's giving you multiple points of execution that you can trade on, and then dives. See these two candles here? That's one consecutive bearish order block. The opening price extended out in time. Why is this a good bearish order block? Because it has that gap, and it's taking liquidity. And there's a market structure shift. There's your high frequency, high power, high probability bearish order block. Forget everybody else's interpretation of my concept, the order block. That's it, okay? What is an order block? You see a lot of people asking, what is an order block? Only my students in mentorship know what an order block is, okay? What it is, it's a change in the state of delivery, okay? It's a change in the state of delivery. The market's being offered higher in these two up-close candles. How did this series of up-close candles begin? With this candle's opening right there. That opening, once this candle trades below it, that changes the state of delivery. So you go back to that point of reference right there. And that's why it's sensitive. The algorithm remembers that right there. Okay, that's all I'm going to give you on the free mentorship level. But that is your answer. Okay, that is what an order block is. It is a change in the state of delivery. Much in the same way, all of this movement down here, all these down close candles, the opening on that candle starts this series of delivery on the downside. When that opening price gets violated here, it changes its state of delivery. Now it was offering sell side. When it goes above that opening, now it's offering buy side. What will it be doing after that? It will be looking for buy stops, buy stops, buy stops, because it's offering buy side liquidity. See, you guys don't even know what you're talking about. You're trying to teach my concepts, and you have no idea what you're doing. You're talking about things in the left side of the chart. Trade it. Do it, okay? You don't even know what you're looking at. And you're hurting the people you call your students. And then right away, when people don't know how to use them or understand what to do with them, they'll say, well, this stuff doesn't work, because they learn from somebody who doesn't know what they're doing, okay? It's blatantly obvious what it is, but okay. Same thing here. Buy side is being offered until that opening price is violated right there. Then a change of state of delivery occurs. Now the market's going to be doing what? Offering sell side liquidity. What's that mean? It's going to start going lower and attacking the sell stops, all the sell side liquidity. It's offering it to the marketplace. That's what's happening. That's what the algorithm is doing. That's what the algorithm does, okay? You buying and selling, me buying and selling, everybody over there on Reddit is not going to change anything at all. It's not going to do anything. And the argument that defeats all that buying and selling pressure is, how do you argue against the bull squeeze and the bear squeeze? There's a short squeeze going on, and the market's rallying up and it's been bearish. That's just their cop out. That's their way of saying, well, you know, everybody's shorting and now recovering. So there it is. And I learned the same thing, folks. I believed all that garbage. 2,000 plus books. I know what those books told me is what you are learning too. Because the same people teaching today, retail garbage, Elliott Wave this and that, it's all stupid stuff, man. It has nothing to do with why these markets are doing what they're doing. Zero has nothing to do with it. Don't worry, I got proof today. But the market goes down to that 50% level because it's going down to what? I teach you. What did I say in the first video? It's going down from a premium market relative to this low and this high. 50% is here, that's equilibrium, so it's going to go down to a discount, and that's that gap right in here. It doesn't look like a gap so much here, but if we go back up one more time, that's that single opening right there. On the 2-minute chart, and then on the 1-minute chart, it's 2 candles that make that up, but you're going to have to do is go through a progression of going from the 3-minute, 2-minute, and 1-minute chart, and you'll get your market structure and your areas of where it wants to look for an imbalance, or old low, old high, and it just makes it easy. But just a real nice delivery there. And here's the lipstick on it on the 1-minute chart. Swing high is broken. Market structure is now bullish. Rallies. Taking buy stops, taking buy stops, taking buy stops. This right here, these highs right here, is just staying below that low. It's building up more interest that this is what? Resistance. That is engineering liquidity. That way, when this runs above it, those individuals that know what you're learning today, they know that that's a pool of liquidity for buyers coming in at a high price. Why is that useful? Because smart money that bought down here, or here, or here, or here, or here, that's where they sell to high-seeking buyers. It's not hard logic, folks. It's not complicated. Okay, it just feels complicated because you see other people trying to teach something, and you hear or read in the comments, "You're teaching it better than ICT does." No, you don't. No, you're not. You're not doing it. You're actually teaching it incorrectly and without the real context of what it is that you're missing. But I get it. You think every down close candle is a bullish order block and up candle is a bearish order block, and that's not the case. Look in here, okay? For the guys that say I did not take trades or I didn't trade this way, you see that gap right there? See that? See that down close candle right there? That's your order block. Boom, buy it right there. What about this? Right here, dropping down. All these candles here are more significant if you look at it on the 2-minute chart. See that? It becomes one order block right in here. Buy it, sell short, buy it again. We got up into the stops, sell short, reverse, and ride the larger swing down. Don't listen to these yahoos out there that say that I'm not proving something to you. I'm proving it. That's what I said I was going to come out here this year and do. That's this whole point of being here this year. It's my 30th anniversary, November 5th. I've been a trader in the markets, living and breathing this stuff for 30 years. You're not really in any position to demand anything from me. I enjoy doing this, but I don't need to provide any kind of proof to you either. But I'm loving it this year. I'm slowly putting it out there and enjoying all the naysayers and the things they're saying. And it's just fun because they have no idea what I'm about to bring this entire year. None of you are going to doubt anything. So the 1-minute chart, just a real nice delivery here as well, filling in that fair value gap, changing the state of delivery. Now it's offering sell side. What's that mean? It's going to match up sell stops. It's going to keep going below old lows into an imbalance until we get down to a discount. Is that hard? Is it hard to see what I'm showing you here? Pretty clean, isn't it? Clean chart. Now, I don't have all these things on my chart when I'm watching price because I already know what I'm looking for. And I don't want to have any distractions, and I don't want to have a level or some kind of annotation that's going to keep me thinking only with that perspective, okay, or that idea. It allows me to be fluid with what the market's actually doing versus going in and saying, okay, this is what I think is going to happen, and this is the only thing that can happen. You understand what I just did there? I allow myself to be flexible, whereas if you have all these things you're putting on your chart, you're only seeing your will be done. So I keep my charts clean. And then I add the annotations so that way my students can see what the internal dialogue in my mind was while watching price do what it does naked. There's nothing on the charts at all when I'm trading. Zero. Nothing. Okay? So with that, I want you to think about how this is useful. Okay? Number one, you're looking at London highs and lows, the session for London open. Okay, for instance, like 2 o'clock in the morning to 5 o'clock in the morning. New York time. Every time I tell you, just always set it with New York local time. 2 o'clock to 5 o'clock in the morning. That's your London session. What's the highs and lows of that session? Okay, that's important because the market's going to probably sweep above those highs or sweep below those lows and create situations like this. Okay, and the New York session is 7 o'clock in the morning to 10 o'clock in the morning, New York local time. Okay, what's the session high and low for that? And do the same thing for Asia. Okay, 7 p.m. to 9 p.m. And that's it. Those are the 3 times of the day that I'm looking for specific key highs and key lows. And any intraday high and low forming right before the equities open at 9:30. Pretty easy, right? The hours of operation, again, are generally between 8:30 in the morning to 11, but it can be extended all the way to New York lunch, noon. I do not tend to take trades after noon local time New York. That hour is usually very problematic, and it's better not to even look for any kind of setups. Wait until 1 o'clock, preferably really 1:30 to 4 o'clock, then you get the afternoon trend. Typically, you'll see between 2 o'clock and 3 o'clock, there's a setup that usually forms in the afternoon trend or setup in that period of time of the day that will also offer opportunities, but that's outside the scope of what I'm going to be teaching in this mentorship. But there's lots of things you can look on YouTube about the afternoon session, and you can just combine some of the things that I'm going to teach you here. And just, it's not hard to make an addition to what you're learning here. That way, if you want to trade the afternoon session, you can obviously pick up some insights from other YouTubers that do trade futures. But for developing students, this is enough. I promise you this is enough, okay? All right, so we talked about internal range liquidity, and internal range liquidity is looking for short-term lows or short-term highs inside a price leg that we're retracing back into. Okay, that's all it means, internal range. Liquidity is a short-term high or low with stops above or below it, or an imbalance in that same range of price action. And I taught you market structure shifts. Showed you exactly all that's necessary. That is all that you require. And the skill set of identifying pools of liquidity, that is going to be something you learn rather quickly just by going through old data and looking at the times of the day I gave you in this lecture. All right, your homework is you're going to go through your E-mini futures intraday charts, and you're going to be looking for stop hunts that lead to market structure shifts intraday. You're going to log your examples with your own annotations for your study journal. So what I showed with the break in the market going higher and lower above old highs or lower below an old low, that's running for stops. That's a stop hunt. Then you're looking for that signature for the market structure shift on the 3, 2, and or 1 minute charts. Okay, if you look for that between 8:30 in the morning to noon New York local time in the E-mini markets, or if you're watching the micro markets, the same logic exists, okay? But you're going to start going back from today and go back as far as the data will allow you. The more you do it and you annotate your charts, the more experience you're going to have. And it's pseudo experience, yes, but you're teaching your brain. I use this analogy a lot with my paid mentorship students. It's like hunters, okay? To know where you're going to find a deer, if that's what you're going to go out and hunt, you need to know how to track one, okay? Or sit up in its tree stand and wait for it to walk by. But usually they go out and they walk around in the woods and they look for tracks. Would you know what a deer track looks like? Before I was shown one, I didn't know what it was, okay? But because I'm showing you what it looks like, that's all this lesson was predominantly focusing on, is the actual view of what it looks like, the details. What you don't need is anything above and beyond what I've shown you. The only thing that you need is what I've shown you here. It's simple, it's straight to the point, and I'm only talking so that way you understand that this is all that is required. Notice there is no commitment of traders. Notice there's no breakers. Notice that? I've stripped it down to the chrome. Now, this isn't the only way you can trade, but I'm showing you something that I think personally, this is my opinion, this is so universally simplistic. All of you should be able to do this one. Okay, in my opinion, I think this is it. And that's why I more or less built it, because I think my daughter, which has zero interest in trading, I think that this is going to be easy for her to see it and understand what to look for. It doesn't have a lot of moving parts. You notice that? It's very specific times of the day, specific highs and lows you're going to look for. It's simple. But you won't appreciate how simple it is until you go back into your charts and you annotate your 15-minute time frame for your buy side liquidity pool and your sell side liquidity pools. And then going down into the 3-minute, 2-minute, 1-minute chart. So for every individual day that you're logging and you're backtesting is just dressing your chart up like I'm showing you here, and then studying it, not just do it and say, okay, I'm done. Really go into to see how price moved and how it delivered. How many pips did it move? How long did it move going higher or lower? How much drawdown did it put on your position if you would have taken one? All of those things, you want to annotate that in your chart. So that way, when you go back through your study journal, you'll have many examples to look at. And because you're looking at it and you're seeing it over and over again repetitively, when you have a period of time where nothing feels like it's working and you feel confused, you want to go back through your study journal and look at these examples because it will encourage you through periods of time where you just feel like it isn't clicking. Okay, it's why it's important to have a study journal, because you're going to see this stuff is happening every single day. And don't take the infancy that you have right now and the lack of experience and amplify that to, there's no way I can learn how to do this, because that's a lie. That's a facade. Don't buy into that view, okay? It's something that you're gonna have to grow into. And it's gonna be quick for some, and it's gonna be slower for others. And there's no way I can make it easier than this, okay? Because that workload that you have to go through of backtesting and logging and acquiring examples, the more time you do that, the more examples you acquire in backtesting, I swear this is the secret, okay? Because that is the thing, that's the work that's required. A lot of people say they do it, but they don't, okay? They go back a couple days and say, oh, I don't feel like I'm getting anything from this. But that's the reason why they fail, because that's the work that's required. You know, having 10 pages in a notebook saying, I took notes. You didn't take notes, you scribbled. You wasted your time. You knew going in you weren't gonna be that headstrong about doing it. And that's what is required to learn this. Otherwise, if you don't have that mindset, this isn't gonna be for you, because it's gonna require work. It's gonna take effort and organization and personal responsibility. If you don't have those characteristics, you need to develop them. If you don't develop them, and patience, you might as well go out there and find somebody that's good at giving you trade signals and just submit to that. And good luck with it. But this isn't it. Another portion of the video I want to show you now. And I'm going to show you this logic actually working today in the NASDAQ E-mini contract. All right, so we're looking at TradingView's chart in the backdrop, and I have the TD Ameritrade open over top of it, scrunched down, so that way I can operate with the TradingView. And I'm going to highlight in TradingView a fair value gap after a market structure shift that's bullish. And I'm going to show you an imbalance that is in a premium. Okay, you see that? Just the opposite of what I've been showing you. Change the color on this. And the idea is I'm going to see it drop down into that green area. But if you look real close, there's actually a smaller little fair value gap just below that green box. Okay, this is not supply and demand. Okay, the idea is I want to see it drop down to that green box. And I don't know if it's going to dip into the lower fair value gap. So whenever there's two fair value gaps like this is for your notes in case you missed this. The idea is I'm going to let it trade down to that lower one. I'll sacrifice that better entry. And if it trades down there and trades into it and then comes right back up into that green box, the first higher fair value gap, I'll enter when it's in there and expect that the lower one won't be retraded to. Okay. I'm going to be trading with a stop that will have essentially 3.25% risk. I'm not suggesting that's a size of risk for you. I'm just telling you that's what I have in mind when I'm taking this trade. And this is, again, just my personal belief in this. I'm not suggesting that you should believe me or subscribe to this view because I'm showing you a live account. This does not mean that every trade you take forward from this day on is going to be like this. It doesn't mean it guarantees profit. It doesn't. But my belief and my faith is that I've seen this work so many times over the last 30 years that I know that this is something that's going to work enough for me. And that's all that matters. It's a personal endeavor when you're speculating. If you don't have any faith in it, then obviously you would never put live money in it. All right, so the market's starting to drop down a little bit in here. And let's say, for instance, that it runs up into that upper rectangle first before going down to the green one. Then I would nix the trade, and that means I wouldn't take a trade, and I would move to the sidelines and probably do nothing the rest of the morning or watch and see if there's something else that sets up. All right, so now I'm inside that rectangle, but notice again, I want to see if it goes down to that lower fair value gap that's not highlighted. I'll mention it when we get into it. That right there, I'm willing to sacrifice that because that's actually the better buy. But if we go back up into the higher fair value gap and create like a tail on this particular candle, I'll see that as just running for a lower imbalance, and then it should accumulate in here. And I have my trigger on the buy button. Okay, I'm just going to go in with a buy at market. I'm not trying to do anything advanced here. Okay, and if you look at the bottom of the TD Ameritrade live account module, you'll see the NASDAQ symbol, and you'll actually see my profit and loss going as the trade is entered. And I took a trade in the E-mini S&P, and it was basically a scratch. I ended up making $75. So I put a trade on and came back on me, stopped me, and that was the end of that. All right, there I am putting the order in. And there's the confirmation that the orders were received. So now I'm long. You can see at the bottom of the pop out, it shows that I'm down initially what looks like $20. And now I'm up $20 right now. So now down 75. So this is the part of trading where it feels scary. If you've never traded with live funds and you just feel like you got to watch that number of how much money you're making and losing, that's the worst thing to do. Okay. What I'm watching is the chart. Does the chart continuously keep giving me feedback visually that it's accumulating and not going lower? Now, it can go one more time back into that lower fair value gap. That's permissible to me. I'm willing to endure that. I just don't want to see it overlap that entire thing and go lower, because then I'd have to close the trade and preferably save my stop. Notice the bodies of the candles are staying relatively inside that fair value gap, that shaded green. Now, again, I'm only adding this to the chart because I knew I was going to record it and share it with you today. But I do not have this in my charts. Okay, the only annotations I have in my charts is when I'm teaching my students. And since you're here, at least for right now, I'm calling you my student. Even the haters. All right. So with the aid of hindsight, because I lived this moment this morning, it does go down one more time and stab into those wicks that are forming. And when you put a trade on, you kind of like give the complete control of everything to the marketplace. And you want to just allow the market to do what it's going to do and not try to overthink every fluctuation. Every little minor movement in the price action is not something that is going to hopefully sway you. So I've already had it in my mind that it could go back down and make a slightly lower low than those two little wicks that it's formed inside the lower fair value gap. So since I had that expectation that it could potentially do that, I'm desensitizing myself to that in the event that it forms. An ideal scenario would be it doesn't do it at all, obviously, but I'm allowing for that price action, especially with the volatility that we've been seeing the last few days. And what I'm thinking right now is they're taking it down one more time to accumulate more longs. Notice I'm saying that, not it's selling pressure, driving price down. I think this is where I took the most heat on the trade, if I'm not mistaken. It was like $455 of trade drawdown while being still in the trade, which is below the threshold I've already said. My maximum risk on a trade, if I'm trading competitively, is 4.5% per trade. Generally, I like to take a trade that I feel comfortable with around 3.5%. That's a good trade for me. Okay, showing signs initially that it's wanting to go higher. And what I'm trying to do is keep my focus on that lower level, or the bottom of that pink rectangle. That's the low-hanging fruit. That's the easy target I'm telling you to try to practice and learn to reach for. The ideal scenario would be to go all the way to the top of that pink. But while you're learning, don't do that, okay? It's easier just to let it trade to the low end and just take it off when it gives it to you. I have my trigger on the flatten button, so it cancels every order, takes me completely out of the marketplace. As soon as it touches the low end of that rectangle, I'll collapse the trade. And right now I'm up almost $900, $895, $935, $925. And again, you can watch that fluctuation in the lower right-hand corner of the pop out. I'm at 1100 plus, 1149. Okay, traded there, touched it. Now I'm collapsing the trade there, just like that. And that's it. Now my account's booked and marked to market with $1,190 in gain. And the balance now reflects it with $27,915.11. So there's TradingView showing the chart I'm watching, because I like TradingView's charts. I don't like TD Ameritrade's charts. I don't like them. So I'm just using the pop out, which is, why are you showing this thing scrunched up? I'm not hiding anything. You can see it. It's right there. So let's go over and take a look at the chart now. You can see nothing has changed. I just magnified that pop out, so it's entirely taking up my entire screen. We're going to go to the NASDAQ E-mini contract symbol. And I am so clumsy with this platform still. But I'm sure I'll get real good at it by the middle of the year. Hint, hint, nudge, nudge. All right, so we're going to look at this day. And there's the chart on 1 minute. And I'm going to add an overlay, okay? But I'm going to put in so you can see where the trades are in that chart. There's the executions, bada bing, bada boom. And there is these areas I showed you on the TradingView chart. So for the inquiring minds that wanted to see a live chart and live account and all that business and the logic of what I'm teaching in the YouTube channel, I humbly submit this. And so I'll talk to you on Thursday. Be safe. All right, folks, welcome back. So this lesson is going to be a little bit shorter, more direct to the point, and we'll be looking at some examples since I showed you what we're looking for on Tuesday night. So Wednesday's trading and Thursday's trading, we'll take a look at that. All right, first up is the E-mini S&P March delivery contract for 2022, Wednesday, January 26th. I want you to take a look at this low over here. Okay, and don't just use my charts. You want to look at your charts and go through it from your platform, your broker, whatever feed that you're using. This is TradingView. It's a free charting package when it's end of data. But if you want to have real time, I think I'm paying $4 a month for the data. It's not really expensive, but you want to have the low over here on Wednesday the 26th, and you'll see why I picked that low there, because it's the low. Okay, and this is the high. So we have this price run from this low to this high. That's our range. So you want to drop your fib on that. Now get your equilibrium price point. So as the highs were ran through, we had that run up. The market gets pushed into a premium. It's really expensive. And then we want to wait to see, does it break down below the old high? It does. But does it create a fair value gap in here? No. Then it rallies one more time. Then breaks down again. Inside here, there's a break in market structure. We see it here. Then it runs back up into the fair value gap here. And then sells off, reaching into this old low, which would be below the equilibrium price point of this entire range, or 50% level on the fib. Okay, put some lipstick on this. Again, here's the low and the high, equilibrium, which is the 50 level on the Fibonacci. So we're looking for a low or an imbalance below this level. Okay, so we have a swing low here. We have an imbalance here. That could be a target. Notice how we hit it there and came off of it. More pronounced low here. And draws down into that. So inside this shaded blue area, we're going to take a closer look at the details. Okay, we're zoomed in a little bit. Again, still on a 2-minute chart. Previous high, short-term high, and 8:30 in the morning. That starts the hunt, basically. That's what 8:30 in the morning is to me. So we're looking for an old high to be violated. It does so here. Then it breaks. There's a break in market structure. Swing low. This candle over here, that sets the stage. Now you have a opportunity. Does price draw back up into the fair value gap after this candle breaks below here and giving you a bearish market structure shift? Yes, it trades up into that fair value gap. You can go short there. And again, you can target this old low here or that low that was annotated before we zoomed in. And look at the beautiful delivery there. So hypothetical short from here and hypothetical cover here. You would log that in your study journal. Don't use my examples here alone. Go into your own charts and annotate them as well. So shorting around, we'll say 44.19 and covering at, we'll say 43.82, just to be, not perfect. That's the opportunity of the range, but you don't have to have all of that. And still very, very nice delivery based on the logic I taught you on Tuesday and the first lesson on the previous week's Friday. Again, there's that fair value gap. And that's your candle that would be considered as an ideal entry. And the discount old low as a target right there. So your charts would look just like this. In any open space like over here, you would just type in whatever important factors that you found insightful about this example. How long did it take? Okay, how long did it take from the market structure shift occurring? How much time did it take to get up into the fair value gap? That's real important. How long did it take before it went from your entry down to your target in time? How much heat or drawdown would you have weathered getting short? Now, if you used this candle's high as your entry point, you technically could have got filled here. But in here, I want to teach you to look at the total range available, and in hindsight, okay, because it gives you a framework to look for how these examples, while they're not exactly the same, they don't repeat exactly photocopy of every single previous instance of it. There's a lot of similarities that you'll find that are reoccurring. And that's the important factor, to train your eye to see it. Remember the analogy I gave you on Tuesday night about the deer track and being a hunter? You have to know what a deer track looks like. You have to know what a deer track is to stalk it effectively. Well, this is your pattern and setup, so you need to go in looking for it so it reinforces the idea that you know what it looks like. All right, we're looking at the E-mini NASDAQ futures for Thursday, January 27th, 2022. This is a 5-minute chart. This is the time frame you start with and you work down, okay? So on the 5-minute right away, we can see the low to the high, and we're looking for a high, and go back in time in your chart, and you'll find what this is here. But you have these relative equal highs as well. So that could have been an initial objective, looking for these relative equal highs to be taken out. And does it break down and give you a fair value gap? No, it doesn't. So it wouldn't even meet the criteria there. I know some of you might be looking and say, well, how do you know it doesn't get you on a trade here? Listen to the rules I gave you. They're very specific, and that's what I'm walking you through here. That way you can see it's kind of allowing the market, or really forcing the market, to show you its hand. Once it does that, then you can go in and act accordingly. But you have to wait for the setup. You can't force it. You can't think it's there or it's not. So we have old high here, buy sell liquidity resting above that, and we have a run above it. Once it goes above here, does it go above it and break down and then go down below that short-term low there? No, it goes higher. So we just keep waiting for a break lower to get a shift in the market structure on an intraday basis. So we have a swing low here. It trades down through it on this candle here. So right away, at that moment on this candle, as soon as this candle trades through it, you now have an opportunity. Then you go back into the high to that candle's low, and do you see a fair value gap? It's right there. Okay, the market rallies back up, trades into it here. You can be a short seller there, and the market breaks down. One more time, retrades back into it, and reaches below the equilibrium price point. Now you have a couple targets here. You can be here, here, or in the imbalance. And it hits all of them and goes a little bit further, lower. All right, so that was quick and hopefully painless. And again, we're looking at internal range liquidity and market structure shifts intraday. My advice is for you to go back through more data, use the weekend that's coming, and acquire more of those examples so that we can include them in your study journal. Next week, I'll work on targeting, refinement, and entries. Until I'll talk to you then, enjoy your weekend, be safe. All right, folks, welcome back. This is the 2022 ICT Mentorship on YouTube. And this lesson is going to be intraday order flow and understanding the daily range. All right, folks, we're looking at tradingview.com, and you can use this platform for free. There are some benefits to having a membership there. It's not terribly expensive, but nonetheless, it provides you a means of looking at charts that I show in my mentorship here and in my private mentorship group. So it's the same charts that I'm producing for that community that I'm producing for you as well. Everything in this lecture is going to be predominantly around teaching you the elements of the E-mini, setting up your daily range and your intraday layouts, and I'll talk a little bit about daily profiles, so that will help you. And I'll compare and contrast, showing you what it is that you're trying to learn from me here versus what is available out there on the internet. Okay, so that way you can decide whether or not this is going to be a worthwhile pursuit for you. These things that I'm teaching today are directly linked to index futures, okay, like S&P, NASDAQ, and the Dow. Okay, you can use the Russell 2000. Those are the markets that I'm targeting with the lessons. The ideas of trading the Asian range and things like that, they're not applicable to these markets. I don't teach that to my students. I want you to just focus on the things that I'm going to show you in this mentorship. All right, first things first, I'm going to get the boring stuff right out of the way. Whenever you're looking at futures, especially the index futures, these contracts trade with expiration dates. And the months that they trade are going to be shown here. ES is the symbol for E-mini S&P. H in this example stands for March. So the delivery month codes for the commodity markets, H is always representing the month of March. M is June. U is September. Z is December. These are the only 4 months that the index futures trade on E-mini S&P, E-mini NASDAQ, and E-mini Dow. Okay. The year obviously is what it is. Now, if you're going to be using, like for instance, when I take live trades in the TD Ameritrade, they don't take their year symbol like this. It's 22. But in TradingView, if you're pulling up the symbol like I have here, ESH2022, that represents the evening S&P 500 contract for delivery month, March, year 2022. Okay. Since they expire, it's important for you to know that the third Friday of the month of delivery, which is obviously in this example here, March, the third Friday of that month is expiration. You do not want to be trading after expiration. And the question is going to be is, when do I start trading the next month out? Okay, this is always going to be the front month or the current month or nearby contract. The month after the front month or current contract month is always going to be referred to by me as the next month out. If you ever have a doubt, you can go to barchart.com and you can go to the select commodity tab here. This is all free. You can scrub down into this list here, go to S&P 500 E-mini, click on that. It'll open up what I just showed you there. And the first one, that's the cash. You don't want to look at that. The next contract available is March. See that? It even gives you a little cheat. Right now, this is considered the front month or nearby contract. The open interest is what I'm watching. Okay, so 1 week before expiration, which is the third Friday of the delivery contract month. So third Friday of March, third Friday of June, third Friday of September, third Friday of December, roll over to a new year, starts the sequence all over again, March, June, September, December. Real easy pattern, real easy means of keeping track of where you're supposed to be at. But usually around the first or second day of the week prior to expiration, I start monitoring open interest. And I want to be in the month that has the larger open interest number. Notice that the June contract only has 57,310 contracts of open interest. Right now, front month or nearby contract of March 2022 has open interest of 2.2 million. So this is the larger liquidity base contract month. So I'm going to be trading this month. If it becomes a matter of this month here has larger open interest than this one here, then I'm going to be trading the next month out because I want the liquidity that's available in the larger pool liquidity offered by the most traded contract month. Okay, so hopefully that answered that question. I have a lot of questions regarding that. All right, so now what we're looking for is an opportunity, and I'm going to teach bias and specific entry techniques next week. This week, I'm teaching you the intraday framework, and I want you to start thinking about market profiles, and you're going to have homework assignments, obviously, for that at the end of this video. But we're going to assume that you were bullish in here, okay? I'm going to provide proof in this video that I was bullish, and I did execute with that bias in mind, but just kind of put that to the side. I know some of you are very anxious, and you're leaving comments saying, can you teach me how to get in? What am I looking for? I understand your excitement, but take the lessons at the pace that I'm giving you, because I'm giving you homework assignments and studying, so that way it helps build and ingrain the understanding I'm giving you, because your study time is actually going to be where the majority of your learning is going to come from. I'm just giving you, points of reference, so that way you can go in and start looking at things and start seeing a repeating phenomenon. But I want to take a look at the 15-minute time frame. All right, and when you're looking at this 15-minute time frame, this is the bellwether time frame. This is where I'm looking for key highs and lows. I'm looking for imbalances like fair value gaps and things of that nature. Yes, I'll look for order blocks, but I'm going to try to stay away from order blocks in this lesson, in this mentorship, really, because I have models that don't even rely on order blocks. Obviously, I'm teaching fair value gap here, and that is the main focus because it repeats. It's an easy pattern. It's there a lot. But I want you to think about how you frame your day. So when you're in TradingView, or you can do this in your own platform if you're not using TradingView, but I'm recommending you, at least while you're going through mentorship here on YouTube, to go through the process with TradingView. All right, and then this is what you would classically see annotated in my chart for a Forex setup. I'm taking you to 830. Okay, you're going to put a vertical line there at 830. Click this, clone. I know this is very boring for some of you because you really want to just get in there and get the nuts and bolts, but I have new people watching the same video, so I have to make this as complete as possible and try to cover all the bases. And then hopefully I don't get as many emails because I can't keep up with them. And so if you've emailed me and I'm not responding, I apologize, but I can't keep up with it. All right, so we're looking at, there you go, that's good. All right, so the equal distance in time in the morning, then an hour lunch, New York lunch, and then an equal amount of time after that, okay? So I'm gonna zoom in here. And in your mind, I want you to think about that lunch hour, and this is always New York local time, okay? Set your TradingView chart to this. If you do that, no matter where you are in the world, you'll be able to calibrate your local time with this, okay? Everything I'm showing you is directly linked to New York local time. If you do it any other time frame, you're gonna mess up. You won't have the same calibrations as all my students and what I'm looking at in price, because eventually I'm gonna be showing you charts on my community tab that I want you to be watching before it happens. But before I even start doing that, I'm not gonna create a train wreck by having everybody looking at charts in their own local time and not New York time and completely miss the point and plot. So once we have this, I want you to think of this hour here noon to 1 o'clock in the afternoon, New York time. That is a no trade time period. I don't care who tells you that they can do this and do that. If you're learning from me, just don't trade during that time, okay? Not even in demo, because just trust me, don't do it, okay? As we go through the mentorship, you'll understand more reasons why I just can't give everything in one video, obviously. And I want to, and I want to do 4-hour-long teachings, but I'm trying to make them palatable because I know majority of you don't have the attention span because you're new and you're just now discovering. So I'm trying to bear that in mind when I'm making these presentations. So you have your daily range on an intraday basis all set up and laid out. So these are your boundaries. Your morning trade is between 8:30 in the morning. Why? Because there's news events that come out at 8:30 all the way to noon, preferably around 11 o'clock. I generally don't like to take trades after 11 o'clock in the morning. Now, that doesn't mean I haven't or that I won't. I just generally try not to. I want to try to be positioned before 11 o'clock and hopefully be riding something into the New York lunch at noon. And then squaring positions or taking some off if I'm going to hold through the lunch and anticipate something going through to the close. And we'll talk about that when we get into profiles. Not volume profile, okay? The idea of the afternoon session, I wasn't going to teach that, but because I see a lot of nonsense on YouTube, I'm just going to teach it to you. Okay, so it's going to be a complete daily treatise on the entire daily range of indices. So that way, if your interest is in this asset class, you'll have a far better chance of being successful, in my opinion, using the information I'm going to give you. Okay, and I'm proving it with actual executions, as you'll see later in the video. All right, so we're looking at prior to 8:30. What are you looking for? Okay, I got a lot of questions in the comments section. I'm reading all the comments, folks. I love it because it's real short little snippets. I know a lot of my students, they like to send me these really long-winded, appreciative emails, and then they give me one chart that doesn't really explain much to me, and I can't really answer it. So the comment section that I'm opening up on every one of these videos, if you haven't noticed, I'm allowing one comment that to kind of like honor those individuals that are showing appreciation and are not gratuitously looking to praise me. I don't like that, okay? I like the appreciation for my time and energy and sacrifice, giving it to you for free, but I don't want to be worshipped, okay? I don't want all that kind of stuff. Don't call me the GOAT, don't call me the greatest of all time. I don't like that kind of stuff. But if you have something that you want me to touch on and improve a delivery or explanation of a specific thing I mentioned in a video, I may already have something in a future lesson planned, but if it's something that I don't have in my outline that's going to be in future videos, I'll utilize the feedback I get, okay? So that way, I understand some of you want everything all at one time, and there's no way I can do all that in one time. But I am taking the feedback I'm getting from you all, and I'm using that, okay? But one of the questions I got was, what highs and lows are we looking for that, a stop run would be framed on, or what would be the catalyst for a stop hunt? Well, prior to 8:30, if you look at that, okay, we'll just grab a horizontal ray, and we see this high here, and I'm utilizing this with the benefit of hindsight, because this is how you're going to go back and back test everything. I want you to take a look at the high here. And the low right here. So prior to 8:30, in other words, to the left of that, on a 15-minute time frame, what's the most significant or obvious swing high and swing low? Swing high is this. It's a candle with a lower high to the left of it and a lower high to the right of it. 3-candle pattern, okay? It does not matter if the candles are up or down closes. You're just looking for a swing high, because above that's going to be buy-side liquidity or buy stops, and a swing low prior to 8:30. That's a candle that has a higher low to the left and a higher low to the right of it. It's 3 candles. Again, it does not matter what the close of the candles are. It has absolutely no bearing on what I'm showing you here, because the swing points are where liquidity is going to be placed. Okay, so once you have these levels on your chart on a 15-minute time frame, then you can drop down into your first lower time frame for entry. That's your 5-minute chart. So let's do that now. All these things will be transposed right to the 5-minute chart. You won't lose anything, in case you're wondering. A lot of new people are afraid if they do something with the time frame, they'll lose their annotations. All right, so now we have this old high back here. Look at this price right there. Okay, that's going to be the high price on that particular candle right there. It's 45.14 and a half. This candle trades to 45.14 and a half. Exactly the same high. When we have that, but look closer, we have relative equal high, but we have it in multiple short-term highs that keep going higher. If there's 3 highs that go up like that, that's a classic 3 drives pattern. There's a book I really enjoyed when I was in the 90s, Linda Raschke and Larry Connor's Street Smarts book. Really nice little book. I don't like everything in the book, but I liked a few of the things that they talked about. And it helped me understand stop hunts, because I couldn't understand it as a developing student, that why would the price want to go for those stops? It didn't make any sense, because the books that I had bought never really explained all that in detail. They just said, trust this pattern of continuation or reversal pattern. And the idea of stop hunts or raids on liquidity never really came up. So it was an alien topic to me. So when I started delving into the charts and started looking at it, it helped me. And the pattern that she and Larry mentioned in there was the 3